Watch this price ladder. A wall of orders just stacked up at one price, thousands of contracts, all lined up to sell. Almost everyone who sees that thinks the same thing. That's a brick wall, the price will bounce right off it. But here's the strange part. A wall that looks exactly like that can mean three completely different things. One is real. The other two are traps. And the catch is, the number on the screen looks identical in all three, so the size alone can never tell you which one you're staring at. By the end of this video, you'll know exactly how to tell them apart, and you'll be able to look at this window, the order book, and read it from zero. Not predict where the price goes. Read what is actually happening in real time, the way experienced order flow traders already do. Let's build it up from nothing. Most charts show you what already happened. Candles, the past painted after the fact. The order book shows you the opposite, what is waiting to happen right now. It's called the DOM, short for depth of market, and it is really just a price ladder. One price per row. On the left, the orders from buyers waiting to buy. On the right, the orders from sellers waiting to sell. Picture a deli counter with a price tag on every shelf, a line of buyers on one side, a line of sellers on the other. We'll use a futures market for this, the E-mini S&P 500, because every order in the world meets in one single book, so the ladder you see is the entire market. Nothing hidden across other exchanges, one clean window. Two prices sit at the heart of the ladder. The highest price any buyer is willing to pay, that's the best bid. The lowest price any seller will accept, that's the best ask, also called the offer. The little gap between them is the spread, and those two touching prices are the inside market, where the next trade happens. In a liquid market like the E-mini, that gap is usually just one tick, the smallest step a price can move, one row on the ladder. Here, one tick is worth $12.50 a contract. If you're wondering where that comes from, a tick is a quarter of a point, and a full point of the S&P index is worth $50. But the takeaway is the simple part. The spread is a small, real cost. You buy at the ask, and the second you want out, you only get the bid. The toll for being in a hurry. One caveat, all of this assumes a deep, busy market like the E-mini. On a thin, quiet one the spread gapes open, and a single order can jump the price. Same rules, rough for ride. Now look at the numbers next to each price. Each one is the amount of size resting there, how many contracts of orders are stacked up, waiting, at that exact price. A big stack is a lot of available orders to trade against. Traders call that liquidity. And when one price has a giant stack, far more than the rows around it, that's what people mean by a wall. It looks solid. It looks like the market has decided something. But keep one thing in the back of your mind, because the whole video turns on it. Every number on this ladder is only a promise. It's an order someone placed, not a trade that happened. And a promise can hold, vanish, or hide. Every order on this ladder is one of two kinds. The first is patient. You pick your price, you place your order, and you wait for someone to come to you. That's a limit order. It rests in the book and adds a stack to one side. The trader who does it is the maker. They are making liquidity, and they name the price on their own terms. Others come to them. The second kind is impatient. You don't wait, you take the best price available this instant. That's a market order. It reaches across and removes a stack from the book. That trader is the taker, and they pay the spread for the privilege of now. Buy that way and you lift the offer. Sell that way and you hit the bid. Patient makers build the walls. Impatient takers knock them down. So here's how price actually moves, and it's simpler than it looks. Say impatient buyers start lifting the offer. They eat the sellers at the best ask. Say there are 500 contracts resting there. The takers chew through the first 200, then the last 300, and now every contract at that price is gone. The level is empty. There are no sellers left there. So the next buyer can only get filled one tick higher where the next sellers are waiting. And just like that, the price ticked up. Not because of magic, but because a level got cleared and the trade moved to the next one. Keep the pressure on and price walks up the ladder, one broken level at a time. That's it. That's the engine under every green candle. Someone impatient, eating through what's resting in the book. But here's the catch. The ladder shows you the size sitting there. It does not show you the moment it gets eaten. For that you need the book's twin window. Time and sales, which traders call the tape. If the order book is the menu of what people say they'll do, the tape is the receipts for trades that actually happened. Each line on the tape, traders call it a print, is one real trade, a price, a size, a time that changed hands. So the book shows what's promised, the tape shows what got done. And the tape hints at who was impatient, a print up at the ask price. A buyer most likely reached across and paid up, the likely aggressor, the one doing the taking. A print down at the bid, a seller most likely hit it. It's an educated read from where the trade printed, not a stamped fact. And the colors are just a default. Most platforms show aggressive buying green and aggressive selling red, but you can change that, so check your own screen. Side by side, the book shows the walls, and the tape shows whether they're being eaten. Quick gut check, because almost everyone gets fooled here first, and not by the market, by their own screen. Everything I just showed you lives on the full ladder. Level 1 shows only the top row, one bid, one ask, the last trade. Level 2 is the whole ladder, every resting order, many prices deep, and on futures that depth is usually a paid add-on. People stare at level 1, see nothing to read, and decide the order book is useless, when really they're just looking at a closed menu. If you trade stocks, the same reading skill transfers. Just know a stock's level 2 is only a partial picture, stitched across many exchanges noisier than the one clean futures book we're learning on. Switch the depth on, and we can finally go back and read that wall from the very start. Phase 1. The wall that holds. Sometimes a wall is exactly what it looks like, a real, enormous order from a seller who means it. The buyers throw everything they have at it. The tape floods green, print after print, and the big number on the ladder slowly gets eaten down. But there is so much of it that the price does not budge, not one tick, until it's all done. That's called absorption, and it's one of the most important things a beginner misreads. Heavy buying with no upward move does not mean nobody is buying. It means one big seller is soaking up every market order, right there in plain sight, and holding the line. The size is real, you can see all of it, and it's winning. The wall held. Phase 2. The wall that vanishes. Remember, a resting order isn't a trade, it's just a promise, and a promise can be taken back. So watch what happens here. The impatient buyers charge toward the wall, and right before they reach it, it's gone, canceled. No trade at all. And with nothing left resting there, the buyers who are charging in have nothing to stop them. So price runs straight up through the empty space where the wall used to be. It was a mirage. Now, traders pull orders all the time for honest reasons. They change their mind, they manage risk, completely legal. But place a giant wall you never intend to fill, purely to trick the market, then yank it, and that's spoofing. It is illegal under United States law. The futures regulator, the CFTC, can come after it with fines and trading bans. And when it's charged as an actual crime, the law allows for up to 10 years in prison. That 10 years is the ceiling, not a typical outcome. The line between an honest cancel and a spoof is one word: intent. Either way, on your screen the lesson is the same. A wall you can't trust can break in an instant. Phase 3 is the sneakiest, the wall that hides. This time you'll see the opposite, a price that looks thin, almost nothing resting there, and yet the orders keep hitting it and it just refuses to break. The impatient orders eat the little stack, and instantly a fresh one reappears. They eat it again, it reappears again. Here's the tell. On the wall that holds, the size was a big number in plain view, draining as it got eaten. Here the number is tiny, and it never drains at all, because every contract they take is instantly replaced from a hidden reserve below. What you're looking at is an iceberg. The trader hid the real size and told the exchange to only show a small tip at a time. Because a giant visible order would scare off the very flow they want to trade against. The name is literal, a display quantity order, the size it's allowed to display while the rest stays hidden. Like an iceberg at sea, You see the cap and almost none of the mass below. So a price that looks weak can be backed by something enormous, and the wall you thought would break just won't. Now everything clicks together. 3 walls, 1 number you cannot trust. The first is real, and it holds. The second looks identical, but it's a bluff that vanishes. And the third barely shows a number at all, yet it can be the biggest of all. Here's the punchline. This whole video has been building to. The size on the screen cannot tell you which one you're looking at. The only thing that reveals a wall's true face is what price and the tape do when the impatient orders arrive. And the tell is different each time. The real wall floods the tape with prints while the price holds, its big number draining in plain sight. The bluff shows you no prints at all. It's gone before a single trade. And the iceberg also floods the tape and holds the price, except the number doing the work is tiny, and it never drains because the real size is hidden. Same ladder, 3 different signatures. That is the shift from staring at the book to reading it. A wall isn't a signal that tells you what to do. A wall is a test. A big stack isn't strong, and a small stack isn't weak, not until it's tested. So here's the whole thing in one line. The book shows you intent, the tape shows you what's real, and price is the referee between them. When a wall appears, don't ask how big it is, ask what it does when it's tested. And stay honest about what this is, reading, not predicting. The order book is one lens, fast, noisy, and full of people trying to fool each other on purpose. It won't tell you who wins. It shows you the texture of the fight in real time, which a candle on a chart simply can't. That alone puts you ahead of almost everyone staring at a wall and guessing. Now I'm curious. If you're brand new, tell me which of the 3 faces, holds, vanishes, or hides surprised you most. And if you've watched a live ladder, what's the most convincing fake-out you've ever seen? A wall that vanished the instant you trusted it. Drop it below. And if you want the rest of the order flow series as it lands, subscribe and read the market with us.